What's up, everybody? This is Leaf with Adaptable Wealth, and today we're going to go over the 5 ways you make money investing in residential real estate. Believe it or not, residential real estate offers 5 different ways to make money, whereas other investments offer maybe 1 or 2. The first way to make money is through cash flow. This is the difference between money coming in and money going out in order to operate, repair, and maintain and pay the mortgage on the property. Think of it like a checking account. You have money coming in, you have money going out. The only way you can have money coming in is to rent out a portion of it or all of it. If you just live in the house and you don't rent any portion of it out, you won't have any money coming in, but you'll have all that money going out. And you're going to have to pay for that difference out of your own pocket. I don't know about you, but I don't want to hold an investment which requires me to constantly put money in order to hold it. I want it to pay me on a net basis. Cash flow is good because it puts a baseline under your returns and you can do whatever you want with the money. You can use it to help offset some of the inflation that we're dealing with right now. You can use it to invest in other assets in order to build a diversified portfolio. Or in my opinion, the best use of these funds is to use your positive cash flow to finance the acquisition of another property that will also have a positive cash flow. Start stacking those cash flows like that for several different properties and you'll develop a second stream of income that helps you get you closer and closer to financial freedom. Lastly, cash flows tend to increase over time, provided you can get a fixed rate mortgage. This is because your mortgage payment, which is the largest portion of your expenses, is going to stay fixed with a fixed rate mortgage. However, your rents are going to start increasing, usually at about the rate of inflation, maybe a little bit more. The second way to make money in real estate is through building equity. Equity is simply the difference between the price you can get on the market for your property and what you still own on it. As I mentioned earlier, cash flow is the checking account of real estate, whereas equity is more like a savings account. There are 3 ways to build equity in real estate: market-based price appreciation, forced price appreciation, and loan paydown. Market-based price appreciation is simply the increase in the price of the property over time due to supply and demand factors. It's a significant driver of financial wealth because of the amount of leverage that you can get with a mortgage. This chart shows what is called the leverage multiple. Depending on what percent you put down, you get a disproportionate increase in your return on investment. A 1% increase in price, you get a 5%, 10%, 20%, or even a 28.6% return on your investment. This is why real estate has played such a large role in the building of so many fortunes. You're dealing with large dollar amounts and you can get tons of leverage to amplify your returns. Based off of the Case-Shiller Home Price Index since 1987, you're looking at a 5 to 6% nominal return due to market-based price appreciation in the top performing markets and about a 3 to 4% nominal return in the lower performing markets. Compare that to the 9% return of the S&P 500 over the same period, and you'll see why I say stocks are so hard to beat and it's the best wealth builder for the average person. The second driver of equity is forced price appreciation. This is where you make improvements to a property and watch the price of the property increase by more than the amount that you put in for the improvements. For example, let's say you put 20% down on a $100,000 property and then put $20,000 to fix up the kitchen or bathroom or something like that. And that resulted in a $40,000 increase in the price of the property. That's a 100% return on investment, and you haven't even capitalized on cash flows, market-based price appreciation, or our fourth way of making money in real estate, and that's the loan paydown. This is the last way to build wealth through equity, and you have 2 options. Either you pay down the mortgage, or you rent the property out and have the tenants pay the mortgage down for you, and you reap the benefits of increased equity. Which one sounds better to you? This is why rental properties make so much sense. Provided you don't default on the loan, you're going to benefit from this loan paydown regardless of what happens to the price of the property or your cash flow. The final way to make money in real estate is through the tax benefits. First, always consult with a tax professional. I'm just a dude on the internet with some experience in real estate providing information and education, not financial advice. Provided the depreciation benefit exceeds the standard deduction, you can write off or deduct anything related to obtaining the loan or operating the property. You can immediately write off things related to operating the property, such as property management fees, routine repairs and maintenance, utilities, gardening, etc. But you're going to have to depreciate the closing costs and capital expenditures over time. Capital expenditures are things like new roofs, plumbing, electrical, renovations, etc. The IRS allows you to treat an investment property as an asset that loses value over time. Provided you're treating it as an investment property and renting it out, you can deduct that loss in value in equal amounts over 27.5 years. You benefit from depreciation because it's a non-cash expense that reduces your taxable income and can be used to shelter some of your cash flow from taxes. For example, if the building portion of the property you just bought was assessed at $250,000, you'd be able to claim $9,000 per year in depreciation. So let's say you generate $18,000 in rental income and that costs you $5,000 in operating expenses. Most people think you have to pay taxes on that remaining $13,000, but that's not true. Once you deduct the $9,000 depreciation allowance, you only have to pay taxes on the $4,000. So you get the tax benefits up front, but the IRS doesn't just give money away. You'll have to pay a portion of that back once you go to sell the property, up to a maximum of 25%. Let's say you held on to that property for 10 years, claiming $9,000 per year for a cumulative depreciation claim of $90,000. When you go to sell that property, you're going to have to pay taxes on that $90,000 at your then current income tax rate, or 25%, whichever one is lower. 25% of $90,000 is $23,000. There are three ways to get around this depreciation recapture. There's the 1031 exchange. You could die, or you can sell the property at a loss to your adjusted basis. The last two options are not desirable, so that only leaves the 1031 exchange. I'm not going to go into what the 1031 exchange is or how to use it and how it benefits you, but I strongly suggest that if you are going to invest in physical real estate, that you fully understand what it is and how to use it. Well, that wraps up the 5 ways to make money, but those aren't the only reasons you want to invest in residential real estate. You often hear the claim that real estate's a good inflation hedge and portfolio diversifier. If those are some questions that you have, check out my videos right here, where we dig into the data and answer those questions once and for all.